Welcome to the Direkt Asset Classes tutorial. You may or may not have heard or read the statement saying that the key to investment return is a diversified portfolio. While we all nod our heads in agreement, most of us get the concept but do not really understand what this truly means. In this tutorial, we will take a look at 4 different asset classes, their pros and cons, how they provide an element of security, risk, or both, and other factors. The 4 asset classes we're reviewing today are cash, bonds, equities, and property. Some would argue that there are now additional asset classes if we are to consider cryptocurrency. However, we are going to exclude this and commodities for this tutorial. Each one of these asset classes holds its value in any person's individual savings. Cash is an excellent asset to have, and many wealth managers advise that before investing, an emergency fund within an easy access account is full and ready to pay for those unexpected bills that come up. Car repairs, washing machine breaks, broken phones, and the like. There is nothing worse than having to cash out your investment because you are forced to rather than want to. It is said that emergency funds should be approximately 3 to 6 times your monthly salary and should always take priority to be refilled when they've been used. The downside of cash is that with interest rates as they stand today, the amount of interest growth that you'll be receiving really is quite low. Currently, inflation, which is the general increase in prices over time, is much higher than the amount of interest being earned on your cash in the bank. To put this in a better way, your 10,000 krona today will buy you less for you in 10 years' time. Likewise, 10,000 krona bought significantly more 10 years ago than it does today. So could you imagine if all of your money sits in a bank account for 50 years, how depreciated it would be? There's a saying, spend like there's no tomorrow, but save just in case there is. Moving on, bonds. Bonds are issued by either corporations or the government and is a debt security. The easiest way to explain this is as follows. If a city, for example, wants to build a new road or a hospital, they may need to raise money. Therefore, it issues a bond. Bonds are traded like stocks and sold to the public. And in return, the purchaser of the bond will receive either a floating or a set amount of interest. And when the company is ready to pay back their debt at the agreed time, the owner of the bond, in theory, will get back the money invested. There is a risk, of course, because companies can go bust and then the payment of the bonds may not be returned. This level of risk is, of course, based on the type of company. A blue chip listed company, for example, is less likely to default than a small, unknown, bad credited company. A blue chip is a company that is nationally recognized, financially sound, and well established. For example, Coca-Cola, Johnson & Johnson, Apple. Also, government bonds are backed by the government and therefore less likely to default. With this, government bonds are likely to pay less interest than that of corporate bonds due to the lower amount of risk associated. Generally, bonds as a whole are the next step up from cash in terms of risk versus reward. Most times there is an element of risk, however, a calculated risk. Therefore, a higher element of interest is payable than that of cash. Keep in mind, over the long term, inflation may impact your investments within bonds. Equities, shares, or stocks is the next asset class to look at. In essence, all of these are the same thing. It is a fact that many people do not understand exactly what a stock is, and so we're going to try and break this down for you. Buying a share in a company is like buying a very small piece of the company itself. The value of this stock will increase or decrease in price based on a number of factors. The two main factors being, one, the remaining amount of assets after a company has deducted all of its liabilities, which basically means what the company's net value is. And two, how popular a share might be, also known as supply and demand, which could actually give a company share a false value. Of course, there are many different variables that can and will affect stock prices, including interest rates, balance sheets, inflation, and many more. Of all the asset classes, this is the most volatile in terms of risk, and therefore investing by buying individual stocks holds the greatest amount of potential for growth and likewise the highest potential for loss. Should a company cease to exist, the stock will no longer be available to be traded, and there could be a total loss of investment. Likewise, if a company flourishes, then the share price will most likely increase. There are many different ways to look at the stability, potential growth risk, and many other factors of a company affecting the share price, and thus affecting your investment decision to buy a share. This takes a huge amount of time, continuity, and expertise, which the majority of us don't hold. The last of the asset classes we're going to discuss today is property. Property can be divided into two parts, commercial and private property. If you have bought your home, you have invested it into your residential property. You are likely to be paying off the mortgage monthly, reducing your debt over time. Many people feel that this is a safe option based on the fact that you can literally feel it, touch it, see it, live in it. However, property also has pros and cons and has risks attached to it that many people haven't realized. Firstly, property prices can increase, meaning that you may make capital growth on your initial investment, which is great, but it is never real until you sell. On the other hand, property prices can also decrease, which means that should you sell, you are going to take a loss on that investment. The risk is that due to unforeseen circumstances, such as losing a job or large interest rate increases on the mortgage, it could mean that you are no longer able to afford your monthly mortgage payments, leading you to default, in effect, potentially losing all or part of your investment. On the other side, a commercial property could be an apartment building with stores underneath, or a shopping mall, for example. With regards to investing into these types of properties, investments are available. Income on this kind of investment can be earned from the capital growth of the property over time, but also from any company or residential rental income earned. Again, there are risks of defaulting companies, increasing interest rates, rents might not be paid, and the like. Financial advisors advise that the best type of investment portfolio is one that suits your individual needs for individual savings goals. However, it could be said that having a hand in all the different asset classes gives you a diversified portfolio. Funds hold a very special arena for these asset classes because you as an investor have the facility to save into an investment vehicle that focuses on shares, property, bonds, and cash, which can all be combined with different weightings depending on the overall amount of risk that you are willing to take and, of course, what is your overall savings goal. Direkt is here to help you, so if you have any questions, please email us on the email below.